Hey guys, Sierra Bailey here with Accel Commercial Real Estate. The video you're watching ties into our event in June, Accelerate. If you want to learn more about what you see today, scan the QR code on your screen or click the link in the description to get your tickets now before early bird pricing runs out. Enjoy the video.
So I'll let you kind of kick off. Maybe you can talk a little bit about yourself, how you kind of got into working with Lument, what you know, how you love the whole Fannie and Freddie. You talk about somebody that's very passionate. Trey and I could sit here and talk for hours, believe me.
We have.
That's true.
Yeah.
That's true.
Well, I would start off by saying congratulations. I did not know that y'all were going to deal with SPN. That's a great shop. So good. Congratulations, Shanna, and to the rest of your team. So like Brian said, my name's Trey Palmedo. I'm with Lument. We were Legacy Hunt. We used to be Hunt Real Estate Capital, but about, feels like the whole pandemic ago, 2 years ago, we were purchased by Oryx Real Estate Capital, or Oryx, sorry. That's a Japanese-based firm. For a minute, we were Oryx Real Estate Capital, and then they rebranded us and two other firms into Lument. And so I guess about 3 years ago now, I started with Hunt to begin our Nashville presence here, started as a singular individual shop. And over the past 3 years, I have built up to one other originator, a couple of analysts, and some administration folks that work all on our team. So we've been expanding our office. Last year was my largest year to date. I did almost $400 million in commercial real estate financing, which related or corresponded to almost $500 million in acquisitions of multifamily across the Southeast, with a big focus on Nashville and Florida, and did some deals in Indiana and Kentucky as well. So I've been in the space for 4 years, which in this thing seems like an eternity. A lot of my clients are kind of all over the place, right? So I have the clients that are syndicators. I have clients that are direct shops that use their own institutional capital. I've worked with pref groups, LP groups. Really seen a lot of it. I would say a couple things that Jana was talking about with respect to the market here in Nashville. It's kind of one of those, I feel safe saying the sentence, if you're not bullish on Nashville, then you're out of the market right now. This city is wild. I was on CoStar today, looking at different assets across sort of this market I've been targeting of Nashville and Madison for multifamily. And I don't think I came across a single one whose vacancy was greater than 1%. So that 5% is an average across the whole city. But in some of these like class C plus, class B to class A minus assets, getting a room is crazy. Like it's the vacancy is basically zero. I mean, you said it right. I think when y'all were talking about retail, but really we use the 5% number in multifamily to say, that's turn numbers, right? So that's just natural organic vacancy that's going to happen when you're turning tenants. So, I mean, my shop focuses primarily on multifamily acquisitions, or at least we do a lot of refinances firm wide, but I've mostly stayed active in the acquisitions market. And, when I first got into this, agency was the really big thing. And it still is. I think the agencies released their numbers for production. Fannie did 70 billion last year. I think Freddie is going to do, they haven't released theirs officially, but they're going to do somewhere around there. I just got back from CREFCOA in Miami, literally yesterday morning, met with Fannie, Freddie folks that were talking about what their year of 2022 looks like. So it's a pretty exciting time in the space. And I would also, before we get into it, I would also say that my firm has, we did a lot of bridge debt this year as well. We did about $2.2 billion worth of bridge. I think I was like, 315 million of it. So it's a good time to be in bridge financing. And, we're focusing primarily on value add multifamily. And if there's folks in here that are looking to do value add multifamily and then turn those and go permanent, that's sort of what our program is a vehicle for. So that's a really attractive product, but you should want to kind of chat.
Yeah, let's kind of talk about, because I know we've got some folks in here that are first time attendees for our event as well. And they may not, truly understand what we mean by agency, right?
Oh, yeah.
What Fannie and Freddie is. They may not understand what bridge is. So let's kind of go through maybe a definition of that. But then also, what are some of the qualifications for, for agency, right?
Yeah, absolutely.
And if they don't have some of those qualifications, say, the 2 years of ownership and some of that, then let's talk about sponsors, right?
Okay,
And some
good
of those. So let's cover some of those that way, folks that may be new. And by the way, too, any of you have questions, you can ask them at any time, right?
Yeah.
So you can raise your hand and ask a question, and we'll go ahead and answer those for you as well. So I forgot to talk about that, but let's talk about agency first, and then let's go into kind of definition of bridge, so they understand what that means.
Yeah,
right?
sure. So back in 2010, post-crisis, Fannie and Freddie were always big players, especially in residential markets. They still are. I mean, a lot of you, if you bought your first house, you did a first time home, you probably saw somewhere in your paperwork, Fannie Mae, Freddie Mac. But what a lot of people don't know is that Fannie and Freddie also provide the financing for about 70% of all multifamily complexes in America. So they have a huge financial exposure to multifamily housing, and they sort of sit in this congressionally delegated responsibility to keep housing in America. I mean, affordable is sort of it, but they do more than just affordable housing, right? So they have exposure in every single asset type across the multifamily spectrum. They also do senior living, but that's not something I know a whole lot about. But yeah, so they have different things about them that make either one more attractive, and there's a lot of different products that they bring to the table. I think probably the two easiest differentiators to talk about between the products is just what is conventional and what is SBL. So the SBL product was designed for multifamily between the 1 and 8 million space.
And that stands for
small balance. Yeah, sorry, small balance loans. Yeah. So and they say small balance. I mean, $8 million is a lot of money to make, but for some of you out there with bigger pockets, it's that's their delegation for a completely different product that's sort of designed to be attractive when you're purchasing that kind of asset. And that product, is anywhere from 75 to 80% of the purchase price. It's got low closing costs. I think legals come in around $7,500, just to give you an idea. Its rates right now are, I think, somewhere around, like, honestly, I've done so much bridge lately that I haven't really done a whole lot of small balance, but I think it's around like 3.4, 3.5. So it's a really attractive product. It's non-recourse. And for those of you that don't know what non-recourse means, it essentially means that you're not backing the asset is backing the asset. So if the deal goes belly up, then they take back the asset and they don't touch your balance sheet, which is a lot different than how banks finance deals. But it's 30-year amortization rates. There's opportunities for interest only. Right now, fixed rates are 10, 12 years, depending on the type of product. It's the way that I've always tried to describe it is that agency products they're sort of a la carte. And I think what makes an effective originator is to understand what the buyer wants inside of a financing product, and then to build sort of like a custom suite product using the agency boxes and the agency capabilities to make a product that kind of aligns with your investment goals. And then outside of SBL, you have conventional, which is 8 million plus, and there's sort of no end to the plus. But that product is similar in some of the things that I said, but there's more opportunities for interest only, and there's different kind of things that go into the SBL with.
Really and I think you said 2 or 3 things that I think are real important for people to understand on with agency. The 2 big ones are the interest only ability to maybe get year, 2 years, maybe more of interest only, but then the whole non-recourse. That's the biggest thing about agency debt that everybody likes, right? Is it's non-recourse. And like Trey said, that means they can't come back after you personally, right? They will take the asset back, but you can guarantee, and like Trey said, agency, they are very they're very tight on what they do when they approve you, right? It's a process to go through, right? They can still get it done in the 60-day time frame, but there are some pretty good restrictions on it from that standpoint, because they don't want to have to come back after that property. What they take less than what? How much back? Very little.
Yeah,
almost none.
It was 3 bips.
Yeah,
last year.
Yeah,
3 bips. 0.03%. I mean, that's crazy. That's a lot.
That's unbelievable, right? But that's so on the front end, they not only when they go through and approve the person or the company or the organization, but then also with the property, right? So they do a good thorough underwriting of both of those. From there. So I think those 2 points are kind of need to be emphasized. And then there was a third one that I can't think of right now.
That's all right.
But I know it may come up. But but then let's talk a little bit about, so when you're talking about bridge debt, what is it like? And for 2021, you said you did a lot of it.
Mm-hmm.
So why was that?
Why was that? That's a good question.
And then what is that compared to?
And also we can talk about qualifiers, because our qualifiers are for our bridge product are very similar to agency. In fact, the whole point of the bridge program is to funnel agency debt, which will make more sense when we start talking about bridge. But I was also going to say, kind of leaning into that about those default rates. So again, just getting back from CREF C, there was a 0.03% default rate in Fannie Mae and Freddie Mac financing last year, but between the two, the aggregate, that was their average, which is just insane. I mean, if you think about, and also it was very similar for 2020, right in the middle of the pandemic, when there was a point where do you remember this number, like 20% of apartments were not paying 20% of tenants in America were not paying their rent, which is nuts, right? Like that's 1 out of 5 people were not making their rent in that sort of, remember that time, that 6 months of 2020. And the reason that the default rates were so low in 2021 and 2020 is because there is a lot of qualifiers to make for a perfect candidate for agency debt. So by the time you go through that, the people that are borrowers of our dollars are highly sophisticated owners and operators with experience and high net worth and high liquid positions that they can wade through those challenging times. So with that, I would go to the bridge question, because that'll give us a great opportunity to talk about qualifiers as well. So bridge is sort of that, bridge financing is meant for that position in between, I'm ready for my permanent debt and I want to do a high value add plan, right? So one of the biggest things that we had in the Southeast to lender dismay and broker delight was rapidly compressing cap rates, right? When I first got in this business, I think, if someone was saying, oh, it's a 5.5 cap, we were like, whoa, that's super low. Now, if someone says it's a 5.5 cap, I'm like, I'll buy it. And so when cap rates rapidly decrease, your balance, your purchase prices go up, your debt yields, which is a lender metric to determine risk, go down. And then really what happens more than anything is that your net cash flow position is just not as strong against your overall loan when you're leveraging a loan 75 to 80% of its purchase price. And then, sorry, that wasn't me. Okay. And then also, with our bridge program, we fund 100% of CapEx. So if you think about that whole loan, it's a little bit challenging to get into a permanent piece when cap rates are 3.5%. So a bridge product exists to fund the acquisition and rehabilitation of a property whose ultimate goal is a significant rent increase. Last year, between all types of multifamily financing, there was $500 billion of multifamily financing went out across all lenders, across all platforms in 2021. $500 billion went through financing. $48 billion of that was bridge financing by about 10 different lenders, and we were one of them. So the exposure to the type of capital that was seeking the acquisition, rehabilitation of multifamily and betting on a 30, 40, 50, 60% rent increase over the next 2 years is significant. It's very significant. And it's tough to exit those properties if you don't hit a 50, 60% rent increase. And in some cases, it's impossible to exit if you don't hit a 40% rent increase, right? So when you're an investor and you're looking at the next 2 to 3 years, you might be saying to yourself, well, are these rents going to keep going up, right? Inflation's more than likely going to keep going up. One of the biggest things, I think J. Powell was saying for a long time, that inflation was transitory. And I think we've all figured out that it's not transitory, but one of the biggest indicators that it wasn't was that it wasn't, there was a lot of opinion that it was supply side, right? That the lack of goods in the industry was causing inflation, but there was also inflation in services, right? Uber Eats became more, Postmates started charging me $10 to bring me Chick-fil-A, which also started charging me $20 for a chicken sandwich, right? So like a lot of these indicators that inflation was here to stay were kind of abundant, and I think they wanted it to be transitory, right? Anybody would want it to be transitory, but with inflation, you also see a natural growth in wages. Ideally, I mean that's how an economy thrives. Is that the more that the inflation rate grows, the more wages grow, and what wages ultimately equate to, if you're a multifamily investor, is your capability to capture more rent growth. So we are sort of betting, I think in the capital markets, we are betting on the idea that the reposition of multifamily will not only have a de minimis impact from rising cap rates, which is bound to happen when rates go up. Maybe there's actually also an economic theory that they may not, but also that wages will pace for folks to ultimately be able to afford a 30 to 60% rent growth. And that is what bridge debt is sort of designed to do. It's designed to take over an apartment complex and be able to invest CapEx dollars, usually from at the minimum $5,000, but even upwards of $15,000, $20,000 a unit, and reposition that asset to where it is a fundamentally better apartment complex. And then we do that by providing those dollars anywhere from 75 to 80% of the purchase price, 100% of the CapEx. Our rates right now, I mean, they were as low as 3.25 in 2021. Right now we're looking at 3.45, interest only over the entire period. There's no debt reserves. It is a very, very investor-friendly product, and we are using that product to facilitate a robust pipeline into our agency piece by essentially saying that, if you don't do agency with us, we'll charge you lots of fees, right? So we are using bridge debt, and so is a lot of other folks. They're using bridge debt to help build their agency pipelines in 2023. So all of that, to talk about the qualifiers, requires very sophisticated sponsorship, right? So what we're looking for our bridge product, what the agencies are looking for their debt, and to kind of keep this whole, what's the right word, song of singing, because, if there are challenging times, we're going to need strong folks, is 3 different qualifiers that once I say them, we'll talk about how they're a little bit easier to achieve, because, sometimes you hear them, certainly I hear them, and I'm like, well, that knocks me out of the ballpark. Yeah, I'm going back to bank.
Thanks for watching this video. If you like what you see, be sure to follow our Generational Wealth Learning Series. On select Thursdays, we offer cutting-edge industry information that would normally cost thousands of dollars. And the best part, our education is absolutely free. If you register through our events page, you can join us live, either in person or over Zoom. In the meantime, like this video, comment down below, and subscribe to our channel so you never miss a beat.